Hello everybody, this is Rodrigo from Learn English Fast, and this class is designed to help you gain a basic understanding of how to read financial statements. It should give you the confidence to be able to look at a set of financial statements and make sense of them. It's also going to prepare you for international certificates such as Gmat, GRE and MBA courses. So, let's begin by looking at what financial statements do. There are three main financial statements, and they are: number one, balance sheets; number two, income statements; and number three, cash flow statements. So basically, balance sheets show what a company owns and what it owes at a fixed point in time. Income statements show how much money a company made and spent over a period of time. And as for cash flow statements show the exchange of money between a company and the outside world, also over a period of time. So let's look at each of those three financial statements in more detail. Balance sheets. A balance sheet provides detailed information about a company's assets, liabilities, and shareholders' equity. So assets are things that a company owns that have value. This typically means they can neither be sold or used by the company to make products or provide services that can be sold. Assets include physical property such as plants, trucks, equipment, inventory, and it also includes things that can't be touched but nevertheless exist and have value, such as trademarks and patents. And cash itself is an asset, so an investment a company makes. Liabilities are amounts of money that a company owes to others, and this can include all kinds of obligations, like money borrowed from a bank to launch a new product, rent for use of a building, money owed to suppliers for materials, payroll a company owes to its employees, environmental cleanup costs, or taxes owed to the government. And those liabilities also include obligations to provide goods or services to customers in the future. Shareholders' equity is sometimes called capital or net worth. It's money that would be left if a company sold all of its assets and paid off all of its liabilities. And this leftover money belongs to the shareholders or the owners of the company. So there's a formula that summarizes what a balance sheet shows. Assets equals liabilities plus shareholders' equity. That's the formula. And a company's assets have to equal or balance the sum of its liabilities and shareholders' equity. Now, if we look into more detail, assets are generally listed based on how quickly they will be converted into cash. Current assets are things a company expects to convert to cash within 1 year. A good example is inventory. Most companies expect to sell their inventory for cash within 1 year. As for non-current assets, they are things a company does not expect to convert to cash within 1 year, or that would take longer than 1 year to sell. Non-current assets include fixed assets, and those fixed assets are those assets used to operate the business, but that are not available for sale, such as trucks, office furniture, and other property. Liabilities are generally listed based on their due dates, and those liabilities are said to be either current or long-term. Current liabilities are obligations a company expects to pay off within the year, and long-term liabilities are obligations due more than 1 year away. Shareholders' equity is the amount owners invested in the company's stock plus or minus the company's earnings or losses since inception, and sometimes companies distribute earnings instead of retaining them, and these distributions are called dividends. And a balance sheet shows a snapshot of a company's assets, liabilities, and shareholders' equity at the end of a reporting period. And it does not show the flows into and out of the accounts during the same period. Now, the next financial statement is income statement. So, an income statement is a report that shows how much revenue a company earned over a specific time period, usually for a year or some portion of a year. An income statement also shows the costs and expenses associated with earning that revenue. The literal bottom line of a statement usually shows the company's net earnings or losses, and this tells you how much the company earned or lost over that period. And income statements also report earnings per share, which is also known as EPS. So, this calculation tells you how much money shareholders would receive if the company decided to distribute all of the net earnings for the period. And companies almost never distribute all of their earnings. Usually they reinvest them in the business. And to understand how income statements are set up, think of them as a set of stairs. So you start at the top with the total amount of sales made during the account period, then you go down one step at a time. And at each step, you make a deduction for certain costs or other operating expenses associated with earning the revenue. And at the bottom of the stairs, after deducting all of the expenses, you learn how much the company actually earned or lost during the accounting period. And people often call this the bottom line. So at the top of the income statement is the total amount of money brought in from sales of products or services. This top line is often referred to as gross revenues or sales. It's called gross because expenses have not been deducted from it yet. So the number is gross or unrefined. And the next line is money the company doesn't expect to collect on certain sales, and this could be due, for example, to sales discounts or merchandising returns. And when you subtract the returns and allowances from the gross revenues, you arrive at the company's net revenues. It is called net because if you can imagine a net, these revenues are left in the net after the deductions for returns and allowances have come out. Now, moving down the stairs from the net revenue line, there are several lines that represent various kinds of operating expenses. Although these lines can be reported in various orders, the next line after net revenues typically shows the costs of the sales. And this number tells you the amount of money the company spent to produce the goods or services it sold during the accounting period. As for the next line, it subtracts the cost of sales from the net revenues to arrive at a subtotal called gross profit or gross margin. It's considered gross again because there are certain expenses that haven't been deducted from it yet, and the next section deals with operating expenses. These are expenses that go towards supporting a company's operation for a given period. For example, salaries of administrative personnel and costs of researching new products. Marketing expenses are another example, and operating expenses are different from costs of sales, which were deducted above because operating expenses can be linked directly to the production of the products or services being sold. Now, depreciation is also deducted from gross profit. Depreciation takes into account the wear and tear on some assets, such as machinery, tools, and furniture, which are used over the long term, and companies spread the cost of these assets over the periods they're used. So this process of spreading these costs is called depreciation or amortization. And the charge for using these assets during the period is a fraction of the original cost of the assets. And after all operating expenses are deducted from gross profit, you arrive at operating profit before interest and income tax expenses. This is often called income from operations. Now, when we talk about earnings per share or EPS, most income statements include the calculation of earnings per share or EPS. This calculation tells you how much money shareholders would receive for each share of stock they own, of course, if the company distributed all of its net income for that specific period. So to calculate EPS, you take the total net income and divide it by the number of outstanding shares of the company. And the third financial statement is the cash flow statement. You know, those cash flow statements report a company's inflows and outflows of cash. This is pivotal because a company needs to have enough cash on hand to pay its expenses and purchase assets. While an income statement can tell you whether a company made a profit, a cash flow statement can tell you whether the company generated cash. So a cash flow statement shows changes over time rather than absolute dollar amounts or pounds amounts at a point in time. So it uses and reorders the information from a company's balance sheet and income statement. And the bottom line of the cash flow statement shows the net increase or decrease in cash for the period. So generally, cash flow statements are divided into three main parts. Each part reviews the cash flow from one of the three types of activities. For example, number one, operating activities. The number two, investing activities. And number three, financing activities. So let's talk about each of them in detail. The first one, operating activities, is the first part of cash flow statement, and it analyzes a company's cash flow from the net income or even the losses. And for most companies, this section of the cash flow statement reconciles the net income, as shown on the income statement, with the actual cash the company received from or used in its operating activities. And to do this, it adjusts net income for any non-cash items, for example, adding back depreciation expenses, and adjusts for any cash that was used or provided by other operating assets or other liabilities. Now, moving into investing activities, the second part of a cash flow statement shows that the cash flow from all investing activities, which generally include purchases or sales of long-term assets such as property, plant, and equipment, as well as investment securities. Like if a company buys a piece of machinery, the cash flow statement would reflect this activity as a cash outflow from the investing activities because it used cash. If the company decided to sell off some investments from an investment portfolio, the proceeds from the sales would show up as a cash inflow from investing activities because, again, it provides cash. Alright? And last but not least, the financing activities. Usually, the third part of cash flow statement shows the cash flow from all financing activities. Typical sources of cash flow include cash raised by selling stocks and bonds or borrowing from banks. Likewise, paying back a bank loan would show up as a use of cash flow. Okay? So, guys, I know this is very generic, it's the basics, but I really hope you have enjoyed this class, and I'd like to thank you so much for being with me all this time. So, I'm going to ask again to subscribe to my channel and click on the button below and make sure to ask all your friends to join us and get all my tips for international certificates such as Gmat, GRE, IELTS, Cambridge and Toefl. So see you guys. I hope to see you next time. So bye for now. Cheers.